Let me tell you something that might change how you think about retirement forever. $350,000 is not a fortune. It is not generational wealth. It is not enough to buy a yacht or a private island or live like a king. But it is enough. It is enough to retire in 5 years, if you understand what I am about to share with you. I have spent over 70 years studying money. I have watched people with millions squander their wealth and end up broke. I have watched people with modest savings build comfortable retirements that lasted decades. The difference was never how much they started with. The difference was always how they thought about money, how they allocated their capital, and whether they understood the simple mathematics of financial independence. Today, I am going to show you exactly what I would do if I had $350,000 and wanted to retire in 5 years. This is not theory. This is not wishful thinking. This is a practical blueprint based on principles I have applied for decades. And if you follow this blueprint, you can achieve something that most people think is impossible. You can buy your freedom. Let me start by telling you a story that shaped everything I know about retirement and financial independence back. In the 1950s, I met a man named Mr. Crawford who worked as a janitor at the school where I attended. He made modest wages. He never earned more than a few $1,000s a year in his entire career. But when he retired, he had more money than most of the teachers, more than the principal, more than many of the businessmen in town. How was this possible? Mr. Crawford understood something that most people never figure out. He understood that wealth is not about how much you earn. It is about the gap between what you earn and what you spend. He lived below his means every single year. He saved consistently. He invested those savings in solid companies that paid dividends, and over 40 years, those small amounts compounded into a sum that provided him security and dignity in retirement. I never forgot Mr. Crawford. He taught me that financial independence is available to almost anyone who is willing to be patient, disciplined, and smart about their money. You do not need a high income. You do not need to be lucky. You need to understand the mathematics and have the discipline to follow through. Now, let me address the elephant in the room. $350,000 for retirement in 5 years sounds aggressive. Most financial advisors would tell you it is not enough. They would show you calculations suggesting you need $1 million, $2 million, maybe more to retire comfortably. They would tell you to keep working, keep saving, keep delaying your freedom until some future date that keeps moving further away. I disagree with this conventional wisdom, and I am going to explain exactly why. The first thing you need to understand is that retirement is not about reaching a magic number. It is about creating a sustainable system where your investments generate enough income to cover your expenses. The amount you need depends entirely on two factors: how much you spend and how much income your investments can reliably produce. If you spend $100,000 a year, you need a large portfolio to generate that income. But if you spend $40,000 a year, your required portfolio is dramatically smaller. The path to financial independence is not just about building wealth. It is about controlling expenses. This is where most people go wrong. They focus obsessively on the accumulation side while ignoring the spending side. They chase higher returns, take excessive risks, and stress about whether their portfolio is growing fast enough. Meanwhile, they spend everything they earn on things they do not need, trying to impress people they do not like. If I had $350,000 and wanted to retire in 5 years, the first thing I would do is get ruthlessly honest about my expenses. I would track every dollar I spend for 3 months, not to feel guilty, not to deprive myself, but to understand where my money actually goes and to identify the gap between my current spending and what I could sustainably spend in retirement. Most people discover surprising things when they actually track their spending. They find subscriptions they forgot about. They find categories where small purchases add up to large amounts. They find areas where they could cut back without any meaningful impact on their quality of life. The goal is not to live like a monk. The goal is to align your spending with your values. Spend generously on what truly matters to you. Cut ruthlessly on what does not. This process often reveals that you can live very well on far less than you currently spend. Let me give you some specific areas where most people can cut without sacrificing quality of life. Housing is typically the largest expense for most families. If you are paying a large mortgage or high rent in an expensive area, consider whether you truly need that much house in that location. Many retirees downsize and find they are happier in a smaller, more manageable home. Transportation is another major expense. Many households have 2 or 3 cars when one would suffice. Cars depreciate rapidly, require insurance and maintenance, and sit unused most of the time. Consider whether you could reduce to 1 vehicle or even go car-free if you live in an area with good public transportation. Food expenses often contain significant waste. Restaurant meals cost 3 to 5 times what home-cooked meals cost. Grocery shopping without a list leads to impulse purchases and food that spoils before it is eaten. Many families could cut their food budget in half with better planning and more home cooking. Subscriptions accumulate silently, streaming services, gym memberships, magazines, software, and countless other monthly charges add up to hundreds of dollars per month for many households. Go through your credit card and bank statements and cancel everything you do not actively use and value. Insurance is often overlooked. Many people are overinsured, paying for coverage they do not need. Review your policies and adjust coverage to match your actual situation. Shop around for better rates. These savings compound over time. The key insight is that most spending is habitual rather than deliberate. You spend money because that is what you have always done, not because you have consciously decided that expense is the best use of your resources. When you bring deliberate attention to every dollar, you often find significant savings without any sacrifice in quality of life. Let me give you a concrete target. If you can get your annual expenses down to $40,000 or less, you can retire on $350,000. That might sound impossible if you currently spend $80,000 or $100,000 per year. But I have seen countless people make this adjustment and report that they are happier after the change than they were before. The second step in my 5-year plan is to invest the $350,000 wisely, not speculatively, not in get-rich-quick schemes, not in complicated strategies that promise extraordinary returns. Wisely in assets that will generate reliable income and grow over time. Here is exactly how I would allocate that $350,000. I would put $250,000 into a diversified portfolio of dividend-paying stocks and low-cost index funds. This is the core of the retirement engine. These investments will generate income through dividends and appreciation over time. For the dividend portion, I would focus on companies with long histories of paying and increasing their dividends. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, and similar blue-chip names that have paid dividends for 50 years or more. These companies are not exciting. They will not double overnight, but they will send you checks every quarter for decades, and those checks will grow over time. Let me explain why dividend growth matters so much for retirement. When I bought Coca-Cola back in 1988, the dividend yield was modest. But Coca-Cola has increased its dividend every single year since then. Today, based on my original purchase price, the effective yield is extraordinary. The dividend alone returns more than my initial investment every few years. This is the magic of dividend growth investing. You do not just receive income, you receive growing income. A 3% yield today becomes a 6% yield in 10 years if the dividend doubles. This growth protects you against inflation and actually improves your retirement over time rather than degrading it. I would build a portfolio of perhaps 15 to 20 dividend-paying stocks across different sectors. Consumer staples like Coca-Cola and Procter & Gamble, healthcare companies like Johnson & Johnson and Abbott Laboratories, financial companies like JP Morgan and Visa, industrial companies like Union Pacific and Caterpillar. This diversification protects you if any single company cuts its dividend or faces challenges. For the index fund portion, I would use low-cost funds that track the broad market The S&P 500 index has returned about 10% annually over the long term. You will not beat the market with this approach, but you will match it, which is better than most professional investors achieve. I have said many times that most investors would be better off just buying a low-cost index fund and holding it forever. The combination of dividend stocks and index funds gives you the best of both worlds. The dividend stocks provide reliable, growing income. The index funds provide broad diversification and capture the overall growth of the economy together. They form a retirement engine that can run for decades. A portfolio of dividend stocks and index funds should generate a yield of around 3 to 4% in dividends, while also growing in value over time. On $250,000, that is $7,500 to $10,000 per year in dividend income, plus capital appreciation, I would put $75,000 into bonds or bond funds. This provides stability and reduces the volatility of the overall portfolio. When stocks decline, bonds often hold steady or increase in value. This cushion allows you to avoid selling stocks during market downturns, which is crucial for long-term success. Bond yields are currently reasonable after being depressed for many years. A portfolio of high-quality bonds should generate 3 to 5% in interest income. On $75,000, that is $2,250 to $3,750 per year in interest income. I would keep $25,000 in cash or money market funds. This is your emergency reserve. It covers unexpected expenses without forcing you to sell investments at inopportune times. It provides peace of mind. And in the current environment, money market funds actually pay reasonable interest rates. This conservative allocation, 70% stocks, 20% bonds, 10% cash, provides a balance of growth, income, and stability. It is not the most aggressive portfolio. It will not make you rich quick, but it will reliably generate income while preserving your capital over the long term. Now let me walk you through the 5-year timeline and show you how this plan comes together. Year 1 is about foundation building. You invest the $350,000 according to the allocation I described. You get your expenses under control and establish your target retirement budget. You continue working and earning income, adding to your investments whenever possible. Your portfolio generates perhaps $10,000 to $12,000 in dividends and interest, which you reinvest to accelerate growth. Year 2 is about optimization. You refine your expense tracking and find additional areas to cut. You learn more about your investments and become comfortable with the volatility of the stock market. You continue working and adding to your portfolio. Your investments have likely grown to $380,000 or $400,000, generating even more income. Year 3 is about stress testing. You live for 3 months as if you were already retired, spending only what your investments could support. This reveals any gaps in your planning and allows you to adjust before you actually quit your job. You continue building your portfolio, which may now exceed $425,000. Year 4 is about transition planning. You think seriously about what retirement will look like for you, not just financially, but emotionally and socially. Work provides structure, social connections, and identity. You need to replace these elements with other activities. You also begin thinking about health care coverage, which is a major expense for early retirees. Year 5 is about execution. Your portfolio has grown to perhaps $450,000 or $500,000 through a combination of contributions and investment returns. You are living well below your means. You have stress, tested your retirement budget. You understand what your life will look like without a job, and you pull the trigger. Now let me talk about the withdrawal strategy, because this is where many people make mistakes that destroy their retirement. The traditional advice is to withdraw 4% of your portfolio each year on $450,000. That would be $18,000 annually, combined with whatever other income you might have. Social Security, if you are old enough, part-time work, rental income. This provides your retirement budget, but I have always believed the 4% rule is too simplistic. It does not account for the sequence of returns, which is the risk that poor market performance early in retirement can permanently impair your portfolio. It does not account for flexibility in spending, and it does not account for the reality that retirement spending is rarely constant. Instead, I would recommend a more flexible approach. In good years, when your portfolio has performed well, you can spend a bit more. In bad years, when the market is down, you tighten your belt and spend less. This flexibility dramatically increases the sustainability of your retirement, and would also recommend focusing on income rather than portfolio IQ. If your investments generate $20,000 in dividends and interest, you can spend that $20,000 without worrying about whether you are depleting your principal. The principal remains invested, continues to grow, and generates income for future years. This income-focused approach provides psychological comfort that percentage-based withdrawals do not. You are spending the fruit of the tree, not chopping down the tree itself. This distinction matters enormously when markets are volatile and portfolio values are fluctuating. Let me talk about some important considerations that many people overlook when planning early retirement. Healthcare is a critical issue. If you retire before you are eligible for Medicare at age 65, you need to find your own health insurance. This can be expensive, potentially several $100s per month or more depending on your age and health status. You need to factor this cost into your retirement budget. There are options to manage healthcare costs. The Affordable Care Act marketplace provides subsidized insurance for people with modest incomes. Health sharing ministries offer alternative coverage for some people. Some early retirees move abroad to countries with lower healthcare costs. Whatever approach you choose, do not ignore this issue. Healthcare expenses can derail even well-planned retirements. Taxes are another consideration. Investment income is taxed differently depending on its source. Qualified dividends and long-term capital gains are taxed at lower rates than ordinary income. Interest from bonds is typically taxed as ordinary income. Tax-advantaged accounts like IRAs and 401k plans have their own rules and restrictions. A tax-efficient withdrawal strategy can save thousands of dollars per year. This might mean drawing from taxable accounts first while letting tax-advantaged accounts continue growing. It might mean converting traditional IRA funds to Roth IRA funds during low-income years. It might mean harvesting capital losses to offset gains. These details matter, and you should educate yourself or work with a tax professional. Inflation is the silent killer of retirement plans. If your expenses increase by 3% annually due to inflation, and your income stays flat, your purchasing power erodes over time. After 20 years of 3% inflation, your money buys only about half of what it did at the start. This is why growth matters in retirement portfolios. You cannot just buy bonds and live off the interest. You need stocks that grow their dividends over time. You need exposure to assets that appreciate. A well-designed portfolio generates increasing income each year, which protects against inflation. Social Security is a wild card for early retirees. If you retire at 50 or 55, you are still a decade or more away from collecting Social Security benefits. You need to survive on your investments until those benefits kick in. Once they do, Social Security can cover a meaningful portion of your expenses, reducing the burden on your investment portfolio. It generally pays to delay claiming Social Security as long as possible, up to age 70. Benefits increase by about 8% for each year you delay. If you can survive on investments until 70, your Social Security benefits will be substantially higher, providing more security in later retirement. Let me discuss the psychological aspects of early retirement, because money is only half the equation. Work provides more than a paycheck. It provides structure, purpose, social connections, and identity. When you retire, you lose all of these things. If you have not prepared for this loss, Retirement can be surprisingly difficult and even depressing. I have seen wealthy people retire and become miserable because they had no idea what to do with themselves. They had defined themselves by their careers, and without that career, they felt lost. They had no hobbies, no interests, no community outside of work. They had plenty of money and absolutely no idea how to enjoy it. Before you retire, you need to answer some important questions. What will you do with your time? How will you maintain social connections? What gives your life meaning and purpose? If your only answer is sitting on a beach, I can tell you that gets old faster than you think. The happiest retirees I know stay engaged with life. They volunteer, they pursue hobbies seriously, they spend time with family and friends, they travel not to escape, but to explore and learn. They may even work part-time, not because they need the money, but because they enjoy the activity and the connection. Let me tell you what I have observed about successful retirees over the decades. They almost always have what I call a portfolio of interests. Not financial interests, but things they care about and activities that engage them. One person might have gardening, volunteering at a local charity, and playing bridge with friends. Another might have woodworking, traveling to national parks, and mentoring young people in their former profession. The specific activities matter less than having multiple sources of engagement and meaning. When work disappears, these activities expand to fill the void. There is no existential crisis because identity is not tied solely to career. Then there's always something interesting to do, someone interesting to see, some project worth pursuing. I recommend building this portfolio of interests before you retire. Do not wait until you quit your job to figure out what you enjoy. Start exploring now, try different hobbies, volunteer with different organizations, take classes, travel, discover what lights you up when you are not being paid. The people who struggle most in retirement are those who have neglected everything except work for decades. They have no hobbies because they were too busy working. They have no close friends outside work because colleagues were their only social connections. They have no sense of purpose because work was their only purpose. When the job ends, they are left with nothing. Do not let this happen to you. Retirement is too precious to waste in aimlessness and regret. Build a rich life now, with or without the job, and retirement becomes a joyful expansion of that life rather than a terrifying void. I have never fully retired myself, and I do not intend to. I love what I do. Work is not a burden I am trying to escape. It is a source of meaning and joy. If you feel the same way about your work, perhaps the goal is not retirement, but financial independence. The freedom to work on your own terms without needing the paycheck. Let me share some specific tactics that can accelerate your path to retirement. Geographic arbitrage is powerful. If you currently live in an expensive city, you can dramatically reduce your expenses by moving somewhere cheaper. The same lifestyle that costs $100,000 in San Francisco might cost $40,000 in a smaller city or different country. This one change can make retirement possible years earlier. I am not suggesting you move somewhere you hate just to save money. But if you are open to exploring different locations, you might find places where your money goes much further and your quality of life is just as good or better. Part-time work in retirement is another lever. If you can earn even $10,000 or $15,000 per year doing something you enjoy, that dramatically reduces the pressure on your investment portfolio. This might be consulting in your former field, teaching, writing, creating, or any number of activities that generate modest income. The key is that this work should be optional. You do it because you want to, not because you have to. Financial independence means you can walk away from any work situation that becomes unpleasant. That freedom is worth more than any additional money. Rental income is another option for boosting retirement cash flow. If you own property or can purchase property with a portion of your savings, rental income can provide steady monthly cash flow that supplements investment income. Real estate has its own risks and hassles, but for some people, it is an attractive component of a retirement plan. Let me address some common objections to this 5-year retirement plan. Some people will say the stock market is too risky. What if there is a crash right when I retire? This is a legitimate concern. A 50% market decline in your first year of retirement could devastate your plan. The answer is the conservative allocation and the cash cushion. If the market crashes, you draw from bonds and cash while waiting for stocks to recover. You have enough buffer to survive a multi-year bear market without selling stocks at depressed prices. This is why I recommended 70% stocks rather than 100% stocks. The diversification provides resilience. Let me share some historical context that should give you confidence. The stock market has survived world wars, pandemics, financial crises, and every other calamity you can imagine. It has always recovered and gone on to new highs. The investors who stayed the course through these difficult periods were rewarded handsomely. I have been investing through every market crash since the 1950s. I remember the crash of 1973 and 74 when stocks fell nearly 50%. I remember Black Monday in 1987 when the market dropped over 20% in a single day. I remember the 2000 dot-com bust and the 2008 financial crisis. Each time, the doomsayers predicted the end of capitalism. Each time, they were wrong. Each time, the market recovered and reached new highs. The key is having a portfolio that can survive the downturns without forcing you to sell at the worst possible time. If your expenses are covered by dividends, interest, and your cash cushion, you never have to sell stocks when they are down. You simply wait for recovery, continue collecting your dividend checks, and let time heal the portfolio. This is the beauty of conservative retirement planning. You do not need to predict market movements. You do not need to time your entry and exit points perfectly. You simply build a portfolio that generates income in all environments and provides enough cushion to weather any storm. The math works even if the market crashes the day after you retire. Some people will say $40,000 is not enough to live on. That might be true depending on where you live and what you want. But I challenge you to actually examine your spending before declaring what is possible. Many people are surprised to discover how much they spend on things that do not bring them joy. $40,000 is more than the median household income in many parts of the country. Millions of families live on less and report being happy. It is all about priorities and expectations. If you expect a retirement filled with luxury travel and fine dining, you need more money. If you expect a retirement filled with meaningful relationships, interesting activities, and peace of mind, $40,000 can be plenty. Some people will say 5 years is not enough time, maybe. It depends on where you are starting from. If you are currently spending everything you earn with no savings, 5 years is probably not realistic. But if you already have $350,000, you are most of the way there. The 5 years is about optimizing, building the final cushion, and preparing yourself mentally for the transition. Let me give you a concrete example of how this might work in practice. Imagine you are 50 years old with $350,000 in savings. You currently earn $75,000 per year and spend $60,000. You want to retire at 55. Year one, you invest your $350,000 according to my allocation. You also save $15,000 from your income, your $75,000 minus $60,000 by year end. Assuming modest 7% investment returns, you have roughly $390,000. Year two, you work on reducing expenses. You find ways to cut $10,000 per year without sacrificing quality of life. Now you are saving $25,000 annually. Your portfolio grows to approximately $445,000 year three. You continue the pattern. Your portfolio reaches around $510,000. You are now living on $50,000 per year and saving $25,000 year four. You push harder on expenses and get down to $45,000 annual spending. You save $30,000. Your portfolio approaches $580,000. Year five, you make final adjustments. Your portfolio exceeds $600,000 at a 3.5% withdrawal rate that supports $21,000 in annual withdrawals. combined with $10,000 in part-time. Work you plan to continue. You have $31,000. Your expenses are $40,000, so you have a small gap, but wait. You have 15 more years until Social Security at age 70. If Social Security will eventually provide $20,000 per year, you only need to bridge the gap until then. And your portfolio will likely continue growing even while you are withdrawing from it because your withdrawal rate is conservative. This example shows how the pieces come together. It is not magic. It is arithmetic. Accumulate assets, reduce expenses, generate income, bridge any gaps with part-time work, and count on Social Security or other future income sources to improve the picture over time. Let me close with some final thoughts about what makes this approach work. The key insight is that retirement is about freedom, not luxury. It is about controlling your time, not buying expensive things. The happiest retirees I know live modestly but freely. They do what they want, when they want, without answering to anyone. Their wealth is measured in time, not dollars. If you pursue retirement through the lens of accumulating enough money to maintain an expensive lifestyle forever, you will never get there. There is always more you could buy, more luxury you could enjoy, more reasons to delay. The goalposts keep moving. But if you pursue retirement through the lens of reducing your needs until your investments can cover them, freedom becomes achievable. Not in 30 years, not in 20 years, potentially in 5 years if you are willing to make changes and accept trade-offs. $350,000 is enough. It is enough to generate income. It is enough to weather market volatility. It is enough to provide security and dignity for the rest of your life, but only if you understand how to use it wisely and have the discipline to control your expenses. I have seen people retire comfortably on less. I have seen people with millions who feel they never have enough. The difference is mindset. The difference is understanding that freedom comes from the gap between what you have and what you need, not from the absolute size of either number. You can be free, you can retire in 5 years. The path is clear, the arithmetic works. The only question is whether you have the courage to walk that path, to make the changes required, to prioritize freedom over status, and to trust the process. Start today. Track your spending, invest wisely, build the gap between your income and expenses, and in 5 years, you can join the ranks of people who answer to no one, who control their own time, who have bought their freedom with discipline and patience. That is what I would do with $350,000 in a 5-year timeline. That is the path to retirement that actually works. And that opportunity is available to you right now, today, if you are willing to seize it.